Hello everyone. So in today's video, let's understand the concept of mutual funds. So we're going to take an example to understand mutual funds in a very simple manner. So let's say there are 100 people who have rupees 10,000 each which they wish to invest. So you could have each of these people doing their own market research and understanding which of the stocks they wish to buy depending on which companies or which form of securities they feel is going to do well in the future. So let's take an example and let's say there are some people who buy shares of Reliance. Similarly, you could have some people who end up buying, say, shares of SBI. Again, you could have some more people out of these 100 who may majorly invest in buying government bonds. And now it's also possible that some of these 100 people we're talking about do not have any idea regarding which stock or which company is doing well in the market. So now, because what you can see is that these 100 people out here represent a diverse set of people in the economy. Some people are aware as to how stock markets function, how companies function, and which are the right stocks to invest in, but some people might not be aware. So let's say these 100 people decide that instead of investing individually by themselves, they decide to pool their money. So let's say you have 100 people pooling the 10,000 rupees which each of them own. So collectively they have a sum of 10 lakh rupees. Now in order to invest this 10 lakh rupees, these people decide that let's hire a fund manager, a professional fund manager or an expert who has a good understanding about the stock market. So let's say they hire a professional fund manager who, let's say, decides that depending on how the markets and companies are doing, let's say decides to invest 5 lakh in securities or equities of companies, say Reliance, SBI, HDFC. Let's say this manager decides to invest a sum of 3 lakhs in Government of India bonds, and he decides to invest 2 lakhs in corporate bonds, say bonds which are issued by Tata Power Limited and so on. So you can see that this manager has invested the 10 lakh sum which he has collected from 100 people in a diverse set of instruments. Now, in order to manage this sum of 10 lakh rupees, this manager is going to charge a management fee from 100 of these people who have pooled in the money. And now these people are going to get a return in the future which will depend on the amount of units they hold. So out here, because there are 100 people, each person holds 1% of the fund. So let's say in the future, the value of the fund increases from 10 lakh, let's say it becomes 11 lakh. So the extra 1 lakh which has been generated is going to be distributed amongst all these 100 people based on the proportion of 1% of the increment is going to be distributed amongst each of these 100 people after deducting the management fee of the fund manager. So this is the basic concept of a mutual fund. That is, it is a financial instrument which essentially collects money from different investors, and once that pool is formed, that pool is invested in a variety of financial assets. So you could have that money being invested in stocks of companies, government bonds, corporate bonds, and in order to manage or to invest that money, you have a fund manager who's appointed to manage that mutual fund. So this is the basic definition of what a mutual fund is. Now every investor who invests in a mutual funds holds a portion of the fund, and that portion which he holds is called units of the fund, and that units of the fund depends on how much he has invested. So you could have someone holding 1 unit of the fund or someone holding 100 units of the fund depending on the amount he has invested. Like we talked about right now, the income or the return which is generated by this fund is distributed amongst all the people who are unit holders of the fund after the deduction of the expenses of the fund manager. So the fund management fee is deducted and the returns are distributed depending on the proportion held amongst different people. So this is the basic concept of mutual fund. Now mutual funds can be of different types. So you can have equity type of mutual funds which primarily invest in shares of listed companies. In fact, in India, there's a requirement by SEBI that any equity mutual funds needs to invest at least 65% in equity shares. So let's say if a mutual fund has 100 rupees, so it needs to invest 65 rupees in equity shares. The other type of mutual funds can be your debt or fixed income funds. So these are mutual funds which essentially invest in fixed income instruments, such as they invest in bonds which are issued by, say, the central government or the state government, as well as bonds which are issued by public sector undertakings and companies or corporates. So you could have mutual funds which invest majorly in bonds or fixed income instruments. The third type of mutual funds are the ones which are called as hybrid or balanced funds. So these mutual funds invest in both equity and debt instruments or fixed income instruments. So you could have mutual funds which say invest 40% in bonds and invest 60% in equity or shares. Likewise, you could have another type of mutual funds which are called as money market or short term mutual funds. So these invest in money market instruments majorly. So they invest in money market instruments such as treasury bills, commercial papers, certificate of deposits. Now we've talked about all these money market instruments in the first set of videos of this playlist. So if you want to know more about that, and in case you haven't watched, you can check that out. Now, while money market mutual funds do not generate a very high return, but they considered relatively risk free, and you have a lot of individual investors and companies which use these mutual funds to park any surplus cash they have, because often the returns on these funds is more than what these investors can generate by parking their funds in banks. The last type of mutual funds are the ones which invest in foreign securities. That is, you could have mutual funds which invest in US government bonds or companies which are based out of Europe. So these funds give investors an exposure to the international market. Now, if you talk about mutual funds are regulated by SEBI, that is Securities and Exchange Board of India regulates mutual funds. Now let's talk about what are the advantages which mutual funds provide to investors. The first advantage is that mutual funds are professionally managed. Now, because they're professionally managed, an investor is free from the burden of conducting research and understanding which company he needs to invest. An investor is free from the burden of being aware of the latest developments which are happening in the stock market or in companies, so as to ensure a good return for himself. So because they're professionally managed, an investor is free from this burden. The second benefit is that mutual funds provide the benefit of diversification. That is, because they invest in a variety of financial assets, say stocks, bonds, and so on. So because the investments are diversified, they help lower the risk which are associated with investment. Because if, let's say, some financial asset is not doing that well, you could have another financial asset which compensates that and assures an overall good return for an investor. The third benefit is that they have a relatively lower cost and allow an investor to invest even smaller sums of money. So let's say an investor invests in a mutual fund which has blue chip stocks of companies. So that is, it has stocks of companies which are top in the stock market in terms of market capitalization. So just by investing a small sum in mutual fund, an investor can indirectly get exposure to these blue chip stock companies. However, if an investor has to individually buy each of these company stocks, he will have to spend a much higher value of money. So that is, by investing a small amount, an investor can get a diversified exposure to a diversified set of financial assets at a much lower cost than if he had to do that individually. The final benefit is that because mutual funds are highly liquid, that is, they can easily be sold if an investor wishes to sell them in the market. So they provide an opportunity to an investor to easily convert them for cash if he desires. So these are the benefits which mutual funds provide. However, mutual funds have two key limitations. That is, the first is the returns are not guaranteed and they depend on market performance. Now, because these are financial instruments which are traded and depend on how the economy is doing, how the company is doing, and what the future prospects of the company are looking, or what is the demand for a particular financial asset, the return which an investor is expected or can expect from these instruments is not guaranteed. It could be higher than what he anticipates, or it could be much lower than what he anticipates. The second is that these funds charge an expense ratio. Because these funds hire a professional manager to oversee the fund, they charge a fund management fee so as to cover the fees of the professional fund manager as well as other operating expenses. So that is the cost which an investor needs to bear if he wishes to invest via mutual funds. So this is all we wanted to cover in context of mutual funds. I hope you liked this video. If you did, follow the channel for more such concepts in regards to UPSC economics. Thank you so much for watching.